What if a small group of economists could conjure trillions of dollars out of thin air just by typing on a computer? It sounds like magic, or perhaps something far more dangerous. Welcome to the Economy Unpacked Daily YouTube channel. From Wall Street to your street, we share the world of money in a clear way. Today, we're unpacking one of the most powerful and controversial tools in modern economics: quantitative easing, or QE. It's a policy where central banks, like the U.S. Federal Reserve, create new money to buy financial assets and inject it directly into the economy. This isn't about printing physical cash. It's a digital flood of money designed to keep the financial system from collapsing. Some have called it economic heroism, a necessary intervention to save us from another Great Depression. Others have condemned it as legalized money printing, a reckless gamble with our future. So, what is the truth? To understand QE, we have to go back to where it all began. Our story starts not in the U.S., but in Japan during the early 2000s. The country was trapped in a debilitating cycle of deflation where prices continuously fall and economic stagnation, often called its lost decade. In a desperate attempt to break free, the Bank of Japan became the first major central bank to experiment with this radical new policy. They started buying government bonds on a massive scale, hoping to pump life back into their flatlining economy. For years, the world watched this experiment from a distance, viewing it as a peculiar response to a uniquely Japanese problem. That all changed in 2008. The global financial crisis ripped through the world economy, bringing giants like Lehman Brothers to their knees and freezing credit markets solid. The U.S. Federal Reserve, led by then-Chairman Ben Bernanke, faced a terrifying prospect. They had already slashed interest rates to virtually zero, using up their traditional ammunition. With the global financial system on the brink of collapse, they reached for what was once considered an unconventional tool. QE became the tool of last resort. The Fed, followed by central banks in the United Kingdom, and the Eurozone launched unprecedented bond-buying programs to save collapsing banks, restore shattered confidence, and prevent a complete economic meltdown. What started as a niche experiment in Japan had just gone mainstream, born from a moment of pure crisis. So how does this digital money printing actually work? It's a multi-step process that starts with the central bank itself. First, the central bank creates new money. This isn't piles of cash rolling off a printing press. It's electronic money created as digital reserves on a computer. Think of it as adding a few zeros to its own bank account. With this newly created digital money, the central bank then enters the open market and buys financial assets, primarily government bonds, from large financial institutions like commercial banks, pension funds, and insurance companies. This has two immediate effects. First, the price of those bonds goes up because of the huge new demand. When bond prices go up, their yields or interest rates go down. This lowers borrowing costs across the entire economy. Second, the banks that sold their bonds are now flush with cash. The goal is that these banks, armed with new liquidity, will be more willing to lend money at cheaper rates to businesses and consumers. This is designed to encourage spending and investment, which in turn stimulates economic growth and creates jobs. It's a chain reaction. The central bank injects money into the financial system, hoping it will trickle down to the real economy. But why would a central bank resort to such a powerful and potentially risky tool? It's not a random act of printing money. It's a strategic intervention with specific goals. The primary motivation is to combat the threat of deflation. When prices fall, people delay purchases, businesses stop investing, and the economy grinds to a halt. By injecting money, central banks aim to create moderate inflation, keeping the economy moving. Another key reason is the zero lower bound. When central banks have already cut interest rates to zero and the economy still needs a boost, QE provides an alternative way to lower borrowing costs and stimulate activity. Most importantly, QE is used to stabilize financial markets during a crisis. In moments of panic, like in 2008 or during the COVID-19 pandemic in 2020, QE acts as a powerful signal that the central bank will do whatever it takes to prevent a systemic collapse. Think of it like this. QE is like an adrenaline shot for a weak economy. It keeps the heart beating when it might otherwise stop, but everyone knows you can't rely on adrenaline forever. Too much can be incredibly dangerous. When used correctly, the positive impacts of QE can be dramatic. There is widespread agreement among economists that the swift implementation of QE in 2008 prevented a total collapse of the global financial system. By flooding the markets with liquidity, it restored investor confidence and put a floor under plunging asset prices. Following the implementation of QE, both the stock market and the housing market began a long, steady recovery. For example, the S&P 500 chart shows a remarkable turnaround from its 2009 low. Furthermore, by pushing down interest rates, QE made it significantly cheaper for governments, businesses, and households to borrow money. This not only helped companies stay afloat and fund new projects, but also allowed governments to finance massive recovery programs without causing interest rates to skyrocket. In the short term, QE has proven itself to be a powerful tool for crisis management, helping to stabilize employment and kickstart economic recovery when all other options were exhausted. However, QE is far from a perfect solution, and it comes with a heavy dose of controversy. The most significant criticism is that it fuels wealth inequality. When the central bank buys assets, it drives up the prices of stocks, bonds, and real estate. Since these assets are disproportionately owned by the wealthy, the rich get richer, while the average person who doesn't own significant financial assets is left behind. This has led to accusations that QE is a policy for Wall Street, not Main Street. Another major concern is the risk of inflation. Pumping trillions of dollars into an economy can eventually lead to too much money chasing too few goods, causing prices to surge. We saw this play out in the aftermath of the massive QE programs during the pandemic, with inflation reaching 40-year highs in 2021 and 2022. Critics also point to moral hazard. The idea that if governments and corporations know the central bank will always step in to bail them out, they are incentivized to take on excessive risk. Finally, QE distorts market signals. By artificially suppressing interest rates, it becomes difficult for investors to accurately price risk, which can lead to speculative bubbles and inefficient allocation of capital. Supporters like former Fed Chair Ben Bernanke argue it was a necessary evil, while critics like investor Ray Dalio warn of its long-term destabilizing effects. The effects of QE are not contained within one country's borders. They create powerful ripple effects across the globe. When a major economy like the United States engages in QE, it weakens its own currency, the dollar. This makes us exports cheaper and more competitive, but it also makes imports more expensive for American consumers. More importantly, the flood of cheap dollars seeking higher returns flows into emerging markets, creating instability. This influx of hot money can cause asset bubbles in countries from Brazil to Turkey. When the U.S. eventually signals an end to QE, that capital can rush out just as quickly, causing currency crises and economic turmoil abroad. This global addiction to cheap money has made it incredibly difficult for economies to wean themselves off stimulus. We've seen asset bubbles inflate worldwide, with housing prices in many major cities soaring beyond the reach of average workers. There is a stark and growing contrast between the wealth generated in financial markets and the stagnant wages experienced by many. QE is truly a global phenomenon, tying the world's economic fate together in a complex web of capital flows and currency wars. Nowhere was the scale of QE more apparent than during the COVID-19 pandemic. In 2020, as the world went into lockdown, central banks unleashed a monetary bazooka, injecting trillions of dollars into the financial system at a speed and scale that dwarfed the 2008 response. The Federal Reserve even introduced the concept of QE infinity, promising to buy assets for as long as needed to support the economy. This unprecedented stimulus, combined with massive government spending, helped prevent an economic depression. However, it's now widely believed to be a major contributor to the surge in inflation that followed. Today, central banks face an incredibly difficult dilemma: how to withdraw this massive support without triggering a market crash or a deep recession. The process of reversing QE is called quantitative tightening, or QT, and it is a delicate and dangerous operation. This brings the reality of QE directly into our daily lives through higher prices at the grocery store, volatile stock portfolios, and the rising mortgage rates that make buying a home more expensive. This leads us to the critical question: can QE even be reversed? The process of quantitative tightening involves the central bank either selling the bonds it owns or simply letting them mature and not reinvesting the proceeds. In theory, this should have the opposite effect of QE. It removes money from the financial system, which should cause interest rates to rise and asset prices to fall. The challenge is that financial markets have become so accustomed to a decade of cheap money that even a small and slow withdrawal of support can trigger panic and volatility. Given the risks of QT, economists are exploring alternative tools for the next crisis. Some have proposed helicopter money, the idea of giving newly created money directly to citizens instead of banks to avoid inflating asset bubbles. Others are looking at central bank digital currencies, CBDCs, which could allow for highly targeted stimulus to be sent directly to those who need it most. The debate is fierce. Has QE become a permanent feature of modern capitalism, a tool that we can no longer live without? So, is quantitative easing an economic lifeline or a ticking time bomb? The answer is complicated. On one hand, it has proven to be an indispensable tool for saving economies from the brink of collapse during moments of extreme crisis. It has restored confidence, supported employment, and prevented depressions. But, on the other hand, it has been a blunt instrument that has likely widened the gap between the rich and the poor, inflated dangerous asset bubbles, and left the global economy addicted to cheap money. QE may have saved the present, but the question we must now ask is, at what cost to the future? What do you think? Do you think QE was necessary, or has it gone too far? Let us know your thoughts in the comments below. And if you found this explanation helpful, please give this video a like and subscribe to Economy Unpacked Daily for more deep dives into the world of money. Thanks for watching.